All right, my friends, welcome. This is one of my favorite things to talk about in the stock market, or one of my favorite events, and that is Federal Reserve press conferences. So, of course, the past 1.5 years has been all about inflation and the interest rates of the Federal Reserve and how that is going to affect the economy. And you can hear all sorts of commentary out there, but really, for this, it's best to go straight to the Federal Reserve and their press conferences. More so now, over this past 1.5 years, than previous market cycles, because it's all about inflation and interest rates, and the Federal Reserve is the place to go for that. So, what has been driving the inflation over the past year and a half? Well, 50% of the inflation has been driven by the consumer sector. The largest contributor to prices in the consumer sector is wages. Okay, so it's important to get the rising wages down for inflation. And so, why have wages been going up? It's because there has been an imbalance between job openings and job seekers. So for every job opening that is out there, or sorry, for every one job seeker, for every one person looking for a job, there are two available job openings for them. So that really creates some supply and demand issues that have really been really the catalyst for the inflation that we see. So, just a moment to stay on this for. So, one of the reasons why there's fewer job seekers than there are job openings is because of COVID. And what COVID did, one of the things it did, was it caused a lot of people to go into early retirement, right? So, people who were 60 years old, they got laid off for a year. Well, they may not necessarily go back into the working force. Perhaps they retire early. And so that has created, and of course, all of the other issues or all of the other changes in the job market that COVID has created. So it's really reduced the number of job seekers. So with fewer job seekers, with fewer people for companies to hire, what the companies then start competing with each other. And so to attract the few workers that there are, the companies have to increase the salaries that they pay to people. That in turn forces the company to increase their prices, which leads to inflation. Okay, so what the Federal Reserve needs to do is they need to either reduce the number of jobs available or increase the number of people willing to, who are looking for jobs. Well, of course, the only thing they can do is reduce the number of jobs available. To do that, they have to slow the growth. How do they slow the growth? Well, they increase interest rates. And that, of course, makes it more difficult for companies to have cash flow, borrow money, all of that kind of stuff, right? Of course, the risk of that is that if they take it too far and they slow down growth too much, then that is going to create a recession. So what the Federal Reserve in the country really needs to see, they need to see fewer job openings, and then they can stop the interest rate hikes. And the interest rate hikes is really what the market has been responding to over the past year and a half. It is what has caused the banks over the past, month and a half to fail, because the interest rate hikes affected the mark-to-market value of their bonds, which created a run on the bank and stuff. So the big question is the Federal Reserve capable of increasing interest rates, slowing down growth, all while avoiding a recession? Okay? And so there were some interesting comments here that the Federal Reserve Chairman Jerome Powell gave that I thought was really good and really concise. So he basically says some things that the increasing interest rates are having the intended effect of slowing down growth, but at the same time not necessarily causing a huge risk for a hard landing or a deep recession. So let's go to Jerome Powell and see what he has to say.
The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. The pace of economic growth in the first quarter of this year continued to be modest at 1.1%, despite a pickup in consumer spending. Activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 3 months of the year, job gains averaged 345,000 jobs per month. The unemployment rate remained very low in March at 3.5%. Even so, there are some signs that supply and demand in the labor market are coming back into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. But overall, labor demand still substantially exceeds the supply of available workers.
Okay, so analysis of what he said. So he mentioned the GDP was 0.9% last year and 1.1% for Q1 of this year. So that is below the historical averages of about 3%. Okay, so that's good. So it shows that the economy is slow, but it's not negative, so it's not a recession. Okay, unemployment is still at 3.5%, which is a 50-year low, which basically means that the economy is really, really strong. It means that the employment is really, really good. He also mentioned that some balance is returning to the employee versus employer scales. And so that is really good news. Wage growth is slowing and job vacancies are reducing. So basically the general concept is that everything is starting to turn the way that the Federal Reserve wants to see things turn, so that they can stop their interest rate hikes and slow things and reverse their interest rate hikes in the coming years, next year or late second half of 2024. Okay, the other thing I wanted to point out is, this press conference was about an hour long. There were a couple questions specifically about recession and a soft landing versus a hard landing. So I'll play those parts for you now. Basically, he says that data and information that he sees, he is encouraged that there will be a soft landing and not any type of deep recession, and he gives some of his explanations for that.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March FOMC meeting that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as you know, we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. You know, it wasn't supposed to be possible for job openings to decline by as much as they've declined without unemployment going up. Well, that's what we've seen. So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild recession.
Hi, Gina Smilik, New York Times. Thanks for taking our questions. I wonder if you could tell us whether we should read the statement today as a suggestion that the committee is prepared to pause interest rate increases in June. And I also wonder if the Fed staff has in any way revised their forecast for a mild recession from the March minutes. And if so, what a recession like what they're envisioning would look and feel like when it comes to, for example, the unemployment rate.
We'll approach that question at the June meeting. So the staff's forecast is so. Let me start by saying that that's not my own most likely case, which is really that the economy will continue to grow at a modest rate this year. And I think that's, so different people in the committee have different forecasts. That's my own assessment of the most likely path. Staff produces its own forecast, and it's independent of the forecasts of the participants, which include the governors and the Reserve Bank presidents, of course. And we think this is a healthy thing, that the staff is writing down what they really think. They're not especially influenced by what the governors think, and vice versa. The governors are not taking what the staff says and just writing that down. So it's actually good that the staff and individual participants can have different perspectives. So broadly, the forecast was for a mild recession, and by that I would characterize as one in which the rise in unemployment is smaller than has been typical in modern era recessions. I wouldn't want to characterize the staff's forecast for this meeting. We'll leave that to the minutes, but broadly similar to that. You put the credit tightening on top of that, and the QT. That's ongoing. I think you feel like we may not be far off, or possibly even at that level.
Thank you, Edward.
Thank you very much, Chair Powell. Edward Lawrence with Fox Business. So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year, or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
To stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. wages. You all will have seen the wage number from late last week, and it's whenever it was, and it's a couple percentage points above what would be consistent with 2% inflation over time. So we do see some softening. We see new labor supply coming in. These are very positive developments, but the labor market is very, very strong. Whereas inflation is running high, well above our goal, and right now we need to be focusing on bringing inflation down. Fortunately, we've been able to do that so far without unemployment going up.
Okay, so lots of good questions and answers there in the press conference today. I've been watching these press conferences for a while, more than a couple of years, and I actually found this one to be one of the more encouraging ones. So, lots of good talk about a soft landing being more likely than a hard landing. So very encouraging. Hopefully this can be the beginning of the end. Keep in mind also that next week, next Wednesday, the inflation numbers for April come out. So there's, as far as interest rate increases go from the Fed, there's seems to be a consensus or a hope that they will pause on the interest rate increases, which will definitely be encouraging for the stock market. Very encouraging. If the inflation numbers next Wednesday come out and they are, in line with expectations or surprise to the downside, then that could be a very positive move, very positive news to possibly create positive moves in the stock market as well. In addition, I was very excited to put a trade on today that I've been waiting about a year to put on. It's on the oil ETF, ticker USO. So did an options trade and maximum gain of, I think it's like 175% in a month and a half. So I will put some info together for that and get it out to you guys. I'm super excited about that because, been waiting a year for the right timing and it happened today. So hopefully that makes money and does not lose everything. But anyways, thanks for hanging out.